Welcome to The Explainer, where we dig into the biggest topics using the data behind the headlines. And today we're tackling a huge one. What is really going on with China's economy?
You've heard it a million times, right? China is on the brink of collapse. No, wait, China is about to take over the world. These two stories are everywhere. But they can't both be true, or can they? Let's figure it out.
Okay, so let's start by looking at these two very different narratives. First up, the case for a total economic collapse.
So the people who see a collapse on the horizon, well, they've got a lot of ammunition. They point to the imploding real estate market, these massive ghost cities, and a local government debt bomb that is just ticking away. Add to that a demographic cliff, a rapidly aging population, and they argue the whole model is basically broken. But then you've got the other side, the domination camp. They look at the very same country and see an absolute juggernaut. An economy that's still growing at around 5%, that's the world's factory, and is totally leading the pack in crucial future tech like electric vehicles and solar power. For them, China's rise isn't just happening, it's inevitable. So, this is the big question. How can the data tell two completely different stories? Well, this is where it gets really interesting, because the numbers themselves seem to point in both directions at the same time.
For the collapse argument, the evidence seems pretty strong. I mean, look at this. This is the Producer Price Index. That line dipping into the negative means that the prices factories are getting for their goods are actually falling. That's a classic warning sign of deflation and really weak demand. And then there's the debt. Oh, the debt. China's total debt has soared to over 286% of its entire economy. That's a number that would send most countries into a full-blown panic.
But then, you see this. Despite all of that, the economy still grew at 5.3% in the first half of the year. Now, that's not the old double-digit glory days for sure, but it's a long way from collapse. And this, right here, this is the paradox in a nutshell. On the left, you've got total debt skyrocketing. But on the right, the official number for bad bank loans is somehow going down. It's getting better. I mean, how is that even possible? Okay, to make sense of this, you have to throw out the standard Western economic playbook. It just doesn't apply here. China has built a completely unique system, and it runs on a hidden engine that some call the mayor economy. So what is the mayor economy? Well, think of it like this. All the big political decisions are made centrally, in Beijing, but the job of actually growing the economy is pushed down to thousands of local officials, and this setup creates some very powerful incentives. Here's the playbook. Beijing sets a huge, ambitious goal, like become a tech superpower. Then, thousands of city mayors act like hyper-competitive venture capitalists, all scrambling to make it happen in their own town. Why? Because for decades, their entire career path, their promotions, depended on one thing and one thing only, hitting those GDP growth targets. And what this system creates is two completely different worlds living side by side. If you're a giant state-owned company, you're living in paradise. You get cheap loans, government backing, the works. But if you're a private entrepreneur, you're born into the jungle, forced to scrap and fight for every dollar.
Now, this system is an incredible engine for growth, no doubt about it. But it's also the reason for all those risks we talked about, the debt bombs, the property bubbles. Which brings us to the most important question of all.
With all these ticking time bombs everywhere, why hasn't the whole thing just blown up? Why haven't we seen a Chinese Lehman Brothers moment, a full-on financial meltdown like we saw in the West? Well, the short answer is because the whole system is a closed loop. The state owns the biggest banks, which are the lenders. The state and state-backed companies are the biggest borrowers. And of course, the state is the regulator overseeing the whole thing. It can't really default on itself.
So what you have is this fundamental trade-off. A Western system is resilient. It can have a brutal crash, but it absorbs the shock and bounces back, often stronger and more efficient. China's system is robust. It's incredibly wasteful, but it uses the full power of the state to stop a crash from ever happening. It trades efficiency for control.
But here's the twist. The entire playbook that we just described, the one that drove China's rise for 40 years, is now being ripped up and rewritten by Beijing itself.
It all started around 2020, with a shocking crackdown on China's biggest and most successful tech companies. The state killed the Ant Group IPO, it forced Didi off the New York Stock Exchange, it basically erased the entire private tutoring industry overnight. The message was crystal clear. The era of let some get rich first was over.
The new game in town is something called common prosperity.
After decades of growth at all costs, the government now believes that the massive gap between the rich and poor is the single biggest threat to its own stability. And that leaves us with the billion-dollar question. It's really the riddle of our time. How do you fix massive inequality without crushing the very innovation and entrepreneurial spirit that made you so successful in the first place? It's a question the entire world is wrestling with, and right now, nobody anywhere knows the answer.